In this video, we're looking at long-term decision making, and this is task 6 from the Applied Management Accounting first sample assessment. So let's have a look at the information we've been given. You manage the accounts of a local farmer who's trying to improve his income streams. The farmer is considering turning one of the fields, which is currently used for grazing land, into a car park, as it is next to the local hospital. He's asked you for your advice on whether this would be appropriate. Details of the cost and income are as follows. So we can see that you have to spend some money to change the surface of the field. So at the moment it's just going to be mud and grass, and they need to probably tarmac that all over. But there will also be an annual maintenance cost of £5,000. There's also going to be a ticket machine for the parking, so that's going to cost £22,000. There's a maintenance of £7,280. But the ticket machine has a residual value, so at the end of the 4-year life we'll be able to sell it on to somebody else for £3,000. And then we estimate that the income will be £68,250 for the next 4 years. So notice that we've given a 4-year life here. So the farmer has a required cost of capital of 10%. And the discount factor at this rate is, so the farmer wants to make sure that it's going to be earning 10% of the initial cost. So we've got the discount factors there for the years, although notice they've given us up to year 5, but we don't actually need that because we only have a 4-year life for the project. So it's asking us then to calculate the net present value of the car park. We need to use minus signs to show if there's any negative cash flows, and we need to enter all the details to the nearest whole pound. So remember that the computer-based software is just focusing on the numbers you enter into the boxes. So if you don't round to the right number of decimal places, then the computer will think you are just wrong. So you need to make sure you follow the instructions carefully. So what do we need to do then? So let's put in some years to begin with. So we're going to start off with year 0. That's when we have to buy and install the car park in the first place. And then we have years 1, 2, 3, and 4. Okay, we don't have to worry about year 5. And then our discount factors, well, we can copy those straight in from the table we can see at the top of the screen. Remember what these discount factors are trying to achieve. We're recognising the time value of money. So if I give you £100 today, you could buy a load of stuff with it, but in 1 year's time, because of inflation, you would be able to buy less with the same £100 because the cost of the goods would go up, but I'm still giving you £100. So we're saying that £100 in 1 year's time is worth less than £100 now. And using the discount rate of 10%, we're saying that if I give you £100 today, well, in 1 year's time, you could buy the equivalent of £90 and 90 pence worth of stuff because those things would go up in cost. So there we are. We've done some of the easy parts of that table. So we've got some marks already, haven't we? But what we need to do now is work out our net cash flows. So we need to look at the table here. So if we think about, first of all, at time 0, so we're going to spend 120,000 on installing the surface for the car park. And also we're going to spend 22,000 on buying the ticket machine. So we've got a cost on day 0 of 142,000. And then what about in the subsequent years? Well, in the subsequent years, we're going to be earning, aren't we, the 68,250. But each year, we're going to have to spend 5,000 on maintenance and 7,280 on maintenance. So the total of all of those, we'll have net income, net cash inflow of 55,970. So that's how much money we're going to be collecting in each year. So that's going to be in years 1 to 3, but we just need to recognise that we get some residual value in the 4th year. So in year 4, we still have to pay for that maintenance. So that's still going to happen. but we earn a further 3,000 of cash when we sell the ticket machine at the end of the life, plus of course the income from that. So that means we're going to have cash inflow of 58,970. Okay, so those are the numbers that we need to put into our table. So we have our cash outflow now of minus 142,000. Remember the question said use minus signs for cash outflows. And then for years 1 to 3, we have plus 55,970. And then in the final year, because we can sell the ticket machine, it's 58,970. So then what we need to do is multiply the cash flow by the discount factor, and then that will give us our present value. So we have 142,000 in times 0, and then when we multiply 55,970 by the discount factor, we get 58,777. Remember, doing a bit of rounding here to the nearest pound. So 46,231, 42,033, 42,777. And then when we add up all of these numbers, that gives us our net present value of 37,418. So that figure is greater than 0, isn't it? So our advice to the farmer would be, well, yes, it would be a good idea to install this car park, because over the 4 years, taking into account the time value of money, you are still going to make some money on this. Right, moving on to part B, it's asking then to calculate the accounting rate of return for the car park. Again, notice in this case, 2 decimal places. So the way that the question's been constructed is giving us a bit of guidance. So we can try to, first of all, to work out the depreciation of the assets. So remember, our depreciation expense is going to be our cost minus the residual value divided by the useful life. So our cost is the 142,000, but we can sell it for 3,000 at the end of the 4 years. So that gives us an annual depreciation of 34,750. Next then, it's asking for what the average accounting profit for the year will be. So in this case, we need our income. So remember what our income was. Again, if we go back to our table, so we have our income of 68,250. We need to deduct the maintenance. So we need to take off the 5,000 and the 7,250, or 280 rather. But we also, for an accounting purposes point of view, we need to deduct the depreciation expense as well. So we deduct the 34,750. And that gives us an average accounting profit for the year of 21,220. So remember, that was the 68,250 minus the 5,000 minus the 7,280 minus the 34,750. And therefore, what's the accounting rate of return? And they've given us the formula. So we want our average profit divided by the initial investment. So that's going to be the 21,220, which we've just calculated, divided by the initial expense of 142,000. And that gives us 14.94%. Remember, that needs to be to 2 decimal places. So, part C of the task asks us identify whether the project should be undertaken using the accounting rate of return as the basis for the decision. So we already identified, didn't we, for the net present value, that was greater than 0, so that said we should go ahead. But for the accounting rate of return, we've got this score of 14.94%, so should we go ahead with it or not? Well, it told us, didn't it, earlier on in the question, that the farmer requires a cost of capital of 10%. So yeah, this accounting rate of return is greater than the cost of capital, and therefore, yes, we should build the car park. And then in the last part of the task, it asks us to identify which investment appraisal technique each of the following statements relate to. So we've got a choice then of the accounting rate of return, net present value, and the internal rate of return. And the multiple choices, you really have a combination of those three investment appraisal techniques. So which of these recognise the time value of money? Well, as we've seen, the net present value uses the time value of money, but also the internal rate of return does as well. So we want to select the net present value and internal rate of return. So let's use this as an opportunity to revise what is the internal rate of return. So if we imagine we're going to do a graph, and on our graph we'll have our cost of capital on the horizontal axis and then the net present value on the vertical axis, and the way it's going to look is a bit like this. So as we increase the cost of capital, there's going to be more discounting, and therefore the net present value gets smaller and smaller and smaller as the cost of capital increases. So we can see the number getting smaller, and at some point, because the discounting will be so high, the discounted cash inflows won't be enough to cover the initial cash outflow, and therefore we'll have a negative net present value. So over here on the left hand side, this is where the net present value is greater than 0, so we should accept the projects. And then over here, where the net present value is smaller than 0, we should reject the projects. So what about the internal rate of return? Well, the internal rate of return is here. The internal rate of return is the cost of capital that will give us exactly a 0 net present value. And in terms of our decision making, if our internal rate of return is greater than the cost of capital, then it means that the project will be giving us more income than it's going to be costing us to raise funds, so we should go ahead. But if the internal rate of return is less than the cost of capital, then we should reject the project. But so we can see then, as the internal rate of return is based on the net present values, it also recognises the time value of money. Okay, the next one then assumes linearity. Okay, so what do we mean by that? So, the word linearity is derived from the word line. Do we have a straight line arrangement? So for our net present value, well, there's no straight line arrangement there, and neither is there any straight line arrangement with the accounting rate of return either. But for net present value, again, do we remember what the formula for that is? So there at the bottom right of the screen is the formula for internal rate of return. So if we just put some numbers onto our chart here, so let's suppose that for this cost of capital, let's call it A, we would achieve this net present value. Let's call that net present value A. And then over here, for this cost of capital, let's call that B, we would achieve this net present value. Let's call that net present value B. Okay, so we're going to have whatever the cost of capital for A is, the rate at A, so that's going to be whatever that number there is. And then what we're going to do is add on to that B minus A. So we're working out what is the difference between these two numbers. But what we want to find out, remember, we're trying to work out what this number is here, that intersecting point. So it's not going to be the full B minus A. We want to just find some way along it. And that's what this part of the formula is trying to achieve, is trying to work out how far along B minus A are we aiming for. So what is the proportion? And we're trying to work out what is that element of the whole distance between B and A. So the way we're going to do that, so you notice that we're just looking at the difference between net present value in A, net present value B. So we're just looking at this measurement. Okay, that's the number on the bottom. And we're just comparing that with this measurement, the net present value of A. So this is where we have the linearity. Okay, so let me just clean up the screen a little bit here because we're just drawing all over it. So imagine that we're going to draw a straight line between these 2 points. So I'm not very good at drawing a straight line, just using my hand. And what the formula does, it says, well, look, if I draw a straight line between that point and that point, I'm going to get that intersecting point there. Now, that's a straight line, isn't it? But the green net present value line is actually a curve. Your net present value is a curved line. So the internal rate of return is just an approximation for what the actual cost of capital will be, where we get 0 net present value. And so this formula is just an estimate. And the estimate is dependent on the 2 rates we choose for A and B. So yes, we do use linearity now because our formula, this part here, uses a straight line to work out what do we think the crossing point is for the curve as it crosses the horizontal axis. So yes, the internal rate of return assumes linearity, because it's just an approximation for what we think the correct number should be. And then the last one includes all available financial data. Well, that's going to be all of them. So one of them by themselves doesn't necessarily use all financial data. It's because the accounting rate of return doesn't include the time value of money. The net present value doesn't include depreciation because it's not a cash flow. So only by using all 3 of them will we be using all available financial data.